Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Let me start with this. Think about this question. What does a real market downturn actually teach you? When you're holding thousands of units, real debt, real partners, and real consequences, what are you actually taking away and how can you apply those lessons into the future, right? And that's exactly what we're going to get today. Not theory, not spreadsheets, just true lessons from experience from an operator that's been in it, as we just talked about, for about 32 years now. Today's guest, he's lived through multiple cycles. He's scaled to over 18,000 units, and he's seen firsthand what breaks when the market turns and what holds. Mark Kenney is the co-founder of Think Multifamily, and he's joining us today to talk about, especially in the most recent downturn, what did that reveal about multifamily? We're going to talk about how to scale without blowing up. And we may even get into, some lessons learned over many partnerships over the years and some things to help you avoid, some mistakes that Mark has learned from along the way, some of that tuition he's paid. So Mark, welcome to the show today.
Good to see you again, Ken. Yeah, definitely have learned one or two lessons, I think, over this downturn.
Yeah, I love that. I just love your willingness to help others learn from the lessons that you've learned yourself, and not have to repeat those. But before we get into the lessons, set the stage for us, Mark. So you started investing over 32 years ago while you were working, you said 80 plus hours a week. So what originally pulled you into multifamily?
So I started originally, I was a senior in college when I have a twin brother, and he and I had zero experience in real estate. Nobody in our family was doing it or anything like that. We were both going to school for accounting, and we're like, man, seem like people need a place to live. We'd like real estate. In some cases, I think you're born certain ways, and other things, nature versus nurture. But we were like, hey, it makes sense. People need a place to live. So we started looking at properties when we were 21. And looked at a bunch. We ended up getting one while we're still in college. And that's what kind of originally got us started, and continued to buy smaller properties, like 2 to 4 units just on our own. And then we both worked corporate world, whether I was a CPA for a while, did IT consulting, had an IT firm, and then switched forward to like 2013. Started looking at syndications, invested passively in a couple of deals, and then quickly kind of started syndicating our own deals in 2015.
So in 2015, as you were kind of ramping up, right? You're syndicating your own deals. I'm curious, what did success look like for you then versus, how do you define success now so many years later?
Well, success during that point in time, which was quite a while ago, was, I say, unfortunately, 100% money driven. Really, that was, and my whole goal was to be able to replace, or we didn't really have to replace, but replace my IT income because I had my own IT firm. And, as you mentioned, I was working like 80 to 100 hours a week pretty consistently. That was my standard work week.
Yeah.
And I'm like, man, this kind of stinks and caused a lot of issues. Just being, I was married, and I'm married now, which is great. It's been over 30 years.
Congrats.
But almost cost me where I wasn't going to be married anymore because of that, right? So I started looking at like alternatives, and my wife and I both loved real estate. We were buying it before, and looked at like, okay, how can I get to where I can quit my IT company? And that was the goal. And we were able to do that after, I guess, a couple of years, 2 years, maybe, pretty quickly. And now success for me has completely switched. Of course, I'm a lot older than you too, but it really is. People are always like, oh, money's not important, stuff like that. Well, it's important to live, obviously. If you want stuff, great. But my whole success story now, if you want to say, or focus has been more on what really matters at the end of the day. And it's not going to be the stuff you have. It's great if you want stuff, but it's going to be relationships. You can have all the money and, have a terrible marriage and your kids don't like you, and health issues and things like that. But when you run into issues, if your whole focus is money driven, that's something that can be taken away. That can be taken away. Your family can be taken away, unfortunately. all those things. So what's the one thing at the end of the day standing that can't be taken away by anybody? And, for me, it really is, relationship with Jesus. And it's a big focus of mine now, but also what's really important from a family perspective. When I get to the end of my life, I want family that loves me and I'm close to. And if you have stuff, great. If you don't, so be it.
Yeah. And I think, that's powerful. And that's, I think a great evolution into a mindset that everybody, would hope to have. But you're right. At the beginning, you start as, money's a necessity as you're trying to build an income to live on. Right. And I'm curious how, were there certain events over those years that kind of led you into this new mindset that were there big milestones, or was it just a progression of kind of, as you said, I don't want to say getting older, but just, getting older and being more mature in your life and kind of realizing, where things really stand? Or what brought you to that new mindset?
Well, we built stuff, pretty quickly overall. And, from a, financial perspective, I wouldn't say we could buy anything we wanted, but, almost anything we wanted. All practical purposes, right? And don't know if this downturn didn't happen, we'll probably just keep going down that path, right? And when things happen, and myself included, but I've talked to a lot of the people too going through stuff, and they're like, "Man, I lost everything." Really, you lost everything? You can still see, you can still hear, you can still walk. You still have a spouse. You still have your kids. No, you lost everything potentially, or almost everything financially. So with the downturn, which I know we'll get into here, to say we got hit hard by that would be a significant understatement. And to say it took a toll on me mentally, my first time in my entire life, that I really, if you want to say, had to deal with something to that degree to where, before I'm way more sympathetic to it now. When I hear people that are like, "Oh, whatever, I have anxiety and fear," I'm like, just get over it. What's your problem? What are you complaining about? Why do you? And then when you go through it, for us, we had, a lot of deals. So we have sold, not all by choice, like 30 deals in the last 2 years. So I've dealt with, lender issues, lender threats. We've had, issues dealing with vendors and investors and, lawsuit, whatever you want, everything you possibly can imagine. And when you go through that and you have a choice, you can keep sitting in that position, which I was in it, probably longer than I wanted to be, but, thankfully to family and friends and things like that, I got through it. And it doesn't mean that all my circumstances have changed, but to say I have a new focus, the best way to get through something like that is through gratitude of things that you have. And you're going to I heard all these stories before, and I'm like, okay, whatever, I've never dealt with that. I never lived in the basement in my mom's house. I didn't live in my car. But when going through this, I'm like, man, I could end up there, the way things are going. So what are you really grateful for? Do you have a place to live? Do you have food? Do you have, all the things you took for granted, or I took for granted, then became more of things I was thankful for. So it's really this downturn that started for us in, 2023, towards the end of it, that made me, refocus really of what really is important at the end of the day. And I'm not saying those other things aren't important because you need to live and things like that. But if your whole focus is on building a business and making as much money as you can, and that's your whole focus, you're going to suffer other areas. I didn't look, I'm sure I didn't look unhealthy during that period of time, but it's pretty hard to go multiple nights in a row without sleeping and eating, 1,000 calories a day, and not to have that impact on you from a physical standpoint as well as mentally. So it can have some pretty significant impact. And I thought I was strong enough to never have to go through that, is reality.
Mm. Well, Mark, I appreciate you being, so vulnerable to share that with us, because it is a fantastic lesson coming through that. And I love the comments on gratitude and realizing, what really matters, and the humbleness that you have there. And so, yeah, just appreciate that. And that is a great segue into where I wanted to go to help others kind of learn from your lessons, right? And as we look at the last downturn. We look at the period of, from 23 to really kind of this year, where interest rates rose, right? Inflation rose. Prices of everything increased drastically, from insurance, taxes.
Multifamily.
Expenses, the expenses of multifamily increased, right? Sure. Especially in certain markets.
Yeah.
Right. And so really appreciate your willingness to come and kind of unpack some of this today so people can learn. And so, first question being, what assumptions did this market downturn expose as flawed?
Yeah. And there are several kind of, if you want to say categories, but if you split it up in different ones, I'll start kind of, around debt, right? So a lot of us, myself included, got a lot of bridge debt, floating rate debt, and floating rate meaning it's going to, float with time and rates. And we had properties that were 4.5% interest rate on bridge that went to 11.5%. Those are real numbers. And where there's no way you're paying your mortgage in that situation. It's just not possible. And if you look at it and say, well, long-term fixed debt, and people always distinguish between bridge and agency, which is like Fannie, Freddie, and things like that. Well, bridge has fixed rate debt and bridge has longer term debt, but a lot of people weren't doing it. It's like, why would you do that? Lock into an 8% interest rate when you can, rates are going to go down, everyone's thinking or saying.
Right.
So the fixed long-term debt is probably the biggest lesson on the debt side. And then looking at lenders that are, if the lender is also an operator, meaning they own properties and operate properties themselves, I would say don't do business with them. Reluctantly do it maybe, because we've been on phone calls before where some lenders are like, hey, we're not operators. We'll work with you. How do we make this work? We've had other conversations where we're operators. We'll just foreclose on your stupid property and take it from you. We don't need you. So, and then the other one around lending would be if they sell their loans off to the market, it can somewhat limit their ability to work with you. So if you're going through this debt, you can't go back and fix, right, what you've already done. You can mitigate a lot of the risks, maybe going forward, or eliminate some of the damage. But going forward on new deals, my personal perspective is fix long-term debt. And people are like, well, of course, you idiot. Why did you do that? Well, the syndicated debt, depending where you look, 96% of it was floating rate debt. So 96% of us are all idiots, right? So, I'm kind of tongue in cheek, but it's like, no, it made a lot of sense. We made a lot of money doing that initially. So you kind of have to look at it and go, and then this whole concept, without going too much into it, between non-recourse and recourse debt. Recourse meaning you have personal liability, non-recourse meaning you have no personal liability. I just say that's not true. It's a myth. It's a lie. Legit or not, lenders will try to come after borrowers. Some lenders will, not all of them. Whether it's, and there are people out there that you and I both know that have done some things pretty, let's just say fraud, unethical. Yeah, they should go after those. But when a lender is trying to make stuff up to sue or come after or threaten a borrower to try to squeeze money out of them, which is what some of them are doing, you need to understand before you go sign a deal. You better understand what bad boy carve-outs are and personal guarantees. And we'll get into the partnership piece here, I think, here in a second too, but joint and several, which you and I are both partners on a deal. I go off and do something. You are 100% liable. Whether you knew about it, participated in it or not, you are 100% liable. And the lender can come after you can't directly for something that I did. And I use the example, growing up, I have an identical twin brother and I was, pretty much perfect kid and he was horrible. I'm kind of joking. I was actually more the one little troublemaker. But it's like, dude, we were both getting in trouble at the same time. Well, it's because you're twins, so I'm going to spank both of you. It's like, well, that doesn't sound right. So I know joint and several from the time I was born. And, but if you don't know these terms and you're like, oh, you have attorneys, that are like, oh, it's just non-recourse debt. Really? You know what that means? Do you know what it doesn't mean? Do you even know what you're signing? So that's one. The other one, real big area that we've looked at, we're in 15 states. And location, without going into all the details, location becomes critical during times of, downturn. It could be from, can you evict or not? We've had places where it's taken us even way after COVID, taking us 16 months to evict. People just don't pay. The other, aspect of it is around values, which you mentioned a little bit but values drastically different across the country. Everyone went down, but the hot markets that were hot, that looked great, were the same markets. I mean, there's a place, we bought in one location, a cap rate in 2022 on average is 4.4%. People are buying even lower than that. And within 2 years, so fast forward from 2022 to 2024, that went up to 7.5%. So there was a 41% decrease in value, which means you can't cover your note, right? If you try to sell it. And you got to refinance, you better bring a lot of money. And then, you have the coastal areas where got hit really hard with insurance. We have one property we bought, it's a bigger one a little bit, but $600,000 for insurance. And that went on renewal 1 year later, went to $3.6 million.
Wow.
So $3 million increase. Similarly, on the debt side, when you're going to renew your rate caps, right, this interest rate protection, people, don't really realize, but that went up in an 18-month period of time, went up over 3,400%. So if you took a $100 million loan, which I'm using as extreme, it was $98,000 for your rate cap. Fast forward 18 months later, it was $3.4 million. That's real money. It's not like on paper. You have to go bring that money to the lender. Right. And most lenders are saying, in addition, buy the loan down. Give me another $5 million to buy the loan down. So, but those are two, and I have some others, but I'll pause there because I'm kind of talking a lot.
No, that's great info. So, I mean, my takeaways, some on the debt side, right, is, you mentioned fixed versus variable, which I think people mostly understand now, right? No one knew where interest rates were going to go. No one could have predicted that, right? I mean, nobody thought they were going to go up. SOFR goes up 4%, right? Yeah. Or 4.5%. But the idea of, fixed seemed expensive back then, but in looking at it, now kind of understanding how variable debt can increase risk just because there's interest rate risk there. It's unknown, right? Versus something you can really underwrite and understand day one. You mentioned the difference between recourse and non-recourse, and even sometimes in non-recourse, they could still come after you, whether it's right or not. Which kind of really led me to this thing of, you mentioned something that makes a lot of sense, and I haven't really encountered much or thought about, but the idea of if there's a lender that's also an operator, and the idea of a shop that might be out there just to try to take over properties at a lower valuation, right? The cost of the debt. And so really understanding the business model, I guess, of the lender that you're working with, right? And being cautious of groups that are also operators. I think that's a great little tidbit of knowledge.
Yeah, we've experienced it directly, right? And you have the people right now that have loans that are maturing or matured, and maybe they're in default. And then, just understanding other aspects of how, without going a lot of details too, you're going to have what's called a P&A, pre-negotiation agreement, if you want to do a loan modification. Typically, the way it'll work is the lender will say, hey, bring the loan current. You're like, well, hey, we can't go raise more money until we know what the loan modification is going to look like. And the lender says, well, no, that's not the way it works. Bring the loan current, then we'll have a conversation with you. It's like, well, how do I go raise more money in that case if I don't know what it's going to look like? Right. Not to mention, if you don't know what a pre-negotiation agreement is, you need to understand what's in it, what's not in it, what you're signing. A lot of people just sign these willy-nilly, if you want to say, not understanding really what they're truly signing. And a lot of the loan modifications that have happened literally make no sense whatsoever. You're just pushing the can down the road and kicking it down the road, and reality is you're going to be in a worse position later on. There are some good ones. I'm not saying they're not, but a lot of them are not good.
But just another really practical tip of, understanding that anytime you're signing a document, it's an important act, right? And to make sure that you've got the proper attorneys involved, the proper people reviewing it to understand truly what you are signing, and not just doing it willy-nilly, as you said, assuming it's kind of just an ordinary thing that everybody has to do, right? And even though there's going to be a little cost to that attorney, that cost may save you in the long run.
100%. And, I've transacted like 200 times between the buy and sell side and, contracts. For whatever reason, I really like contracts. But I've learned a lot of why I like it now is because I learned so much about, frankly, like, man, I should probably change that, whether we're selling a deal or buying a deal and things like that. But investors included, how many investors really truly read a PPM document before they invest? Mm-hmm. The word risk shows up in general over 60 times. Loss shows up 60 plus times. There's not a single PPM document where I've ever read where it's like, you are guaranteed a return. But of course, investors will say, well, didn't you guaranteed a return? You promised this return and things like that. Mm-hmm. So at some point in time, I'm an LP in deals that have, not worked out.
Yeah,
you take responsibility for that, and lenders, they've done their own underwriting on these deals. They did the loans. They did their own appraisals. They did, they have more access to information than we do. A lot of lenders didn't require rate caps for the interest rate protection. And why didn't they do that? Because they thought rates would never go 11 times either. So
right.
You're never going to find a lender that sits there and takes responsibility for this. It's just not going to happen,
Yeah, it's always going to fall back on you. And so you got to make sure you're really protecting yourself and understanding what you're doing, right? I think that's well said. And then you mentioned also geography, right? And how that plays in. And I'm curious you said you've invested across 15 states. Are there, with the lessons learned now, are there places you would not invest again or places that you would invest based on learning out of those 15 states?
Both. Yeah. If you look at it, now, if you're going to enter back in the market today, this year or whatever, next year, pricing's down quite a bit. So you can argue there's going to be some pretty good discounts and they're already out there, right? And eventually they're going to start making a lot of sense to start acquiring. And these hot markets, let's pick some. Austin, Miami, Phoenix, they got hit so hard, right? But the discounts, if you took Jacksonville, Florida is down, went down 41%. The example I gave, that was for Jacksonville. And Memphis, Tennessee, or people would typically probably cringe to go, oh, Memphis, right? Well, Memphis during 2022, 24 went down 8%. So it's a boring market. Is it going to go up 40% in a short period of time? No, it's never going to probably do that. But it's also not going to probably go down 40% in a 2-year period either. So you probably can enter, I'm not giving financial advice, probably can enter these markets that are down, 40. Austin places in Austin down 50%. I know a guy has an $86 million deal from a couple of years ago. It's worth $42 million today in Austin. So you pick up some of these deals. I would just say you want to exit before, exit when that's top of the market and you never know what it is. But just if you want to hold it for a couple of years, you're probably going to do okay. You want to hold it for 7-8 years, probably not going to do okay. If you hold it for 20, you're probably okay. You just can't time the market.
Do you think do you think in those markets, do you think the adjustment, the pricing adjustment is a correction from just being overinflated, or do you think it's an over adjustment? And I'm sure it's, again, market specific.
Really good question. It's a really good question. And I think it's probably overly, personally. How much? I don't know. But, to argue that, and, places in Austin have gone on 50% in like a 2.5-year period, it's like, you're pretty hard to convince me that values are really down that much and not going to pick back up again.
Sure.
We all know real estate, over time will go up, but I think, there's definitely an overcorrection. And part of it's because of the buyer pool. You try to sell a deal 2024, 2025, even broker opinion values are going out there. We have tons and tons of examples where, they're 30, 40% off on their opinion values. And these guys, they're not making stuff up. The market wouldn't bear it.
Yeah.
As new money enters in the market and things start adjusting and the uncertainty, there was so much uncertainty with interest rates. You might have had a deal, this is not exaggeration, where your interest rate during, a 4-month period of time went up 200-300 basis points, so 3%. Like, that doesn't sound like that much. Well, that is like significant.
Sure.
Whatever, a 60% increase probably in interest rates. So, and they're, So the areas I would say are some of the boring markets, Midwest are probably, my personal opinion, you want deals that cash flow.
Yeah.
And some people might say, well, why did all these stupid people even get bridge debt? Well, the deals that a lot of people bought, ourselves included, they didn't qualify for Fannie and Freddie. Generally speaking, you need to be occupied 90% or higher for 90 days or more. And we were going in and we had deals before where, 17 months, we more than doubled our money on a value add deal. I mean, that's if you want to act like everyone's a genius during that period of time and everyone's great, even as an investor, look how smart I am. Well, you're going to have to own up for the times, myself included, when things aren't going that well. So it's not like all these people are out there, if you want to say, just deliberately making dumb decisions. I mean, it's not the case. Everyone's using data, survive to 2025. Well, how did that go?
Right.
Persist to 2026. Well, okay, we'll see.
Yeah.
I make it up. Having in 2027, I'm making that up. No one has said that, but
not yet.
Yeah, right. So nobody really knows. And you have other aspects of a deal. I mean, I won't spend a lot on taxes, but the tax implications of all these things with deals being sold, you can't put $100,000 in a deal, get depreciation and stuff like that, lose all your money in the deal and still owe taxes when the deal sells. People are like, well, how's that possible? No, it's possible. You hear people saying, oh, depreciation and all this is, limited and 25%. Well, I can give you examples where that's not the case. So any investor that gets into a deal, and a GP in particular, without going into all the details like negative capital accounts and things like that, you're going to have a potentially huge tax implication. I mean, I have one deal alone. This is one deal. We sold 30 deals where the one deal for me personally, my personal perspective, was like a $260,000 tax liability for one deal that we sold, made no money off it.
Wow.
Well, you got all that benefit from depreciation. Yeah. 7 years ago, that was already used.
Right. So it was a depreciation recapture was where that
correct.
That came from. Yeah.
You just really need to know when you're in deals, and even as an LP, you really need to look at all your deals you're in on an annual basis at least, and say, if I sold all my deals today, what's my tax liability?
Yeah.
CPA, get a CPA that knows real estate. I can't tell you how many people say, oh, my real estate, my CPA knows real estate. And I'm like, they don't. I can tell you what you're asking me, what you're telling me. Countless examples where CPAs are wrong. So, you kind of have the debt, you have location, you have the taxes, and then, you have, type of deal, whether it's cash flowing or not. I'm more interested in cash flowing now. Yeah. And then the other, big category for me is partnerships, which I think you wanted to touch on too.
Yeah. But I'm curious. I mean, I know we've hit a lot of great lessons there. I mean, just gems for people to go back and listen to and really take heart of. But I'm also curious, were there things that you did right that helped you weather that period? I mean, I know it was a tough period, but were there things that you felt you did right and said, man, I'm glad we did it this way? Anything on that side of the fence as well?
Probably more things I would say I wish we didn't do, including putting money in, personal money, like significant, right?
Yeah.
With the end result kind of being the same, but not really, using data we have and things like that.
So try keeping the deal alive on your own.
Keeping the deal alive. So you want to say that's a right thing or not? Don't get me wrong. Every investor that loses money has every right to be completely frustrated, ticked off, that's no one really should debate that.
Yeah.
But I can at least look at like, well, hey, the last 2 years worked for free, full time, right? Trying to fix deals, put in, sold a bunch of stuff to put money into deals to try to, save them before going to investors. So my biggest thing it would be more around, I can at least say, hey, I didn't do anything maliciously, deliberately, knowingly or anything like that. I think that you learn a lot going through it. And then when you go through more deals, we've actually had deals where we said, you know what, we're not going to do a capital call on this deal, and go to the investors and say, this is why we're not doing a capital call, because we don't see any way out. That's tough.
Yeah.
you're going to lose all your money for sure, but you might lose your money plus new money coming in. So
Yeah.
learning through that. So we did pivot and adjust on what we did on certain deals and say, okay, well, based on what happened on these other deals, how would we do things differently on these other deals that have problems? So not raising capital was good for sure on some deals. I wish we wouldn't have raised capital on some other deals. We did. Open communication with lenders is really, really important. You don't ghost them, don't ignore them. You just don't do that. So that was good. Communicating out to investors is a mixture, I would say, because in some cases you just don't have the information to communicate out. I understand people are like, hey, I want answers. And then you're like, well, if I put this out there, then there are going to be all these questions around like, okay, well, what am I going to make? When I get money back? Am I going to lose my money? All these things that come out there. So
yeah,
that's kind of an in-between, but definitely communicating out to investors like, hey, we're in trouble. Don't wait till you're, last minute. We're in trouble. This deal needs capital. Here's what it looks like from a sale perspective. If we were to sell it, here's what it looked like from a refinance and things like that. So got better about laying out the different options and the pros and cons of each option, and then which one, in my personal opinion, made the most sense on each deal, which is it's unique per deal. So
yeah,
those are some of the things for sure, that we did right. A lot of things that you want to say were done wrong were already fixed and decided on, 3 years ago when we entered into the deal. That couldn't be corrected, right? We can't correct the cap rates. We can't correct what rate caps are going to go to or what, rates are going to go to or anything like that. So, yeah.
No, understood. And again, I think all of these are really helpful. And as we think about, for the passive investors that are listening, what are questions that they should be asking sponsors that, they probably weren't asking before?
Yeah.
Like, are there some things for folks to dig into?
Yes, for sure. And I'm not going to, do this to be critical, but I'm going to be somewhat critical. All these, I'm just going to call them stupid posts out there about everyone. And it's a lot of people are just upset, right? I get that, right? But the reality is that LPs make a decision, myself included. I'm LPs in other people's deals, right? And they get there and say, well, it's all the operator. All you have to do is vet the operator and you're going to be totally fine. I mean, I can show you post after post, like on LinkedIn and stuff like that. That's literally the dumbest advice you can possibly give somebody, my personal opinion. So one, everyone listening to this, either personally or in business or both, you've been surprised by somebody. I mean, it could be your spouse. It could be your kid. It could be your business partner. I have an example where a business partner literally forged my signature and sold the deal without telling me. True story.
Wow.
Oh, don't you trust it? Yeah. Well, no, I don't trust hardly anyone anymore. Why would I? You need to put stuff in writing, right? That's going to fix a lot of these things. And I've done tons and tons of partnerships now to where I know what to put. I know what to put in there.
Yeah.
As an LP, you need to understand how to underwrite a deal in some respects. You don't have to be an expert in it. And people are like, well, I'm just relying on the syndicator. Well, for one, your PPM document's going to have a lot of stuff in there that if it doesn't scare you as an investor, then you're not reading the document. Right.
Yeah. So
you need to become educated. But the loss, risk, all those things are going to be in there all over the place, right? And then you want to understand the debt, right? The debt, that's probably one of the most important things you can possibly understand is the debt.
Yeah.
And if you don't understand, hey, is it fixed long term or whatever it might be? Is it Fannie, Freddie, Bridge? That's going to be number one to look at. What does it look like? What are the, people don't understand either like prepayment penalties, whether it's, step down without going into it, yield maintenance, defeasance. People don't even know what things are.
Right.
But they're investing, $50 or $100 or $1,000 plus more. And then they want to blame somebody every time something happens. Right. And I get, again, the frustration. A lot of people are direct people. Just ask these questions. What good is it to ask a question? I can ask you a question. You give me an answer. I'm like, okay, I can read your answer. I have no idea what it means. I don't even understand it. So if one is knowledge and understanding what you're reading, right? And then ultimately it's converted into wisdom. And I'm not just, it's like, okay, now how do I use this knowledge and understanding information to now make wise decisions? Very, very few people have the wisdom. First, they don't have the understanding. So first of all, if you're going to ask questions, you need to understand what you're asking, and with the response, what are you going to do with that? You should be able to get the financials, understand that, look at what's being done today at the property for like expenses and what things are going to be done going in the future. What are their differences? You want to understand, have they engaged things around, like a tax consultant for property taxes? People got burned on that a lot. You want to understand the market yourself, location wise, what's happening. It's not just like the state. People like that state's landlord friendly. Very few, because you still have, let's just call it, liberal counties that are pro tenant. So even in states that are so-called landlord friendly, still have these counties that are not landlord friendly. And it's really the county level,
right?
Is where you get burned,
right?
So understanding, the dynamics. And then, you really need to understand the physical aspects of a property. If you look at it and go, well, this is a 1960 property. Okay, maybe it's all been redone. But if not, you're going to have issues with, plumbing just is a, horrendous issue on all these older properties.
Yeah.
So you need to understand the physical characteristics of the building that you're potentially investing in. The sponsor people, you can ask the sponsor 1,000 questions. And they can answer every question perfectly. It doesn't mean they're a good guy or gal. It doesn't mean that it's so overemphasized that, all you have to do is look at the operator. Operators can get you out of these things. No, that's not true. The example where our insurance went up $3 million in a year, give me one operator in the entire world that can go into that deal and make that deal work. It's impossible. Right. It's not even practical. So understanding the financials without being an expert, understanding the debt, super important. Whether if the coastal market, you just need to understand there's a bigger risk there. Is it going to go, is the debt going to be fixed long-term right away? Yes or no? I would prefer that personally as an investor, kind of going forward for myself. How do you mitigate as many risks as possible? If the operator's never been in that market before, there's more risk there. If we've done, 20 deals in Georgia, I know the market a lot better, and I can, I can't eliminate all risk. No one can. But you can mitigate, some of the risks. So the more unknowns that you can turn into knowns, you're going to be better off. And then you just need to understand, you have no control as an LP to make decisions typically. You typically can't even decide when to sell a property or refinance it or anything like that. People all complain about that. It's like, well, that's what you went into it, going into it. So get educated, own up to your decisions, and then like I said, debt and location are probably the two biggest. And then partnership wise, which I think if we get time, we'll get to it, is like understanding who's making decisions. Any 50-50 partnership is a disaster waiting to happen. You always need a tiebreaker in your operating agreement. If you're going to invest in a deal and Kent and I are in it, or 50-50 partners in it, and I want to sell the property and all the investors want to sell, which is a real example of a deal I have, and Kent doesn't want to sell, then we're not selling the property. For 50-50 partners, it's silly. You can make a 50-50 from an economic standpoint, but from a decision-making standpoint, you need a tiebreaker in the operating agreements. It's legally binding. Whatever that third-party person is or group that makes a decision, then you're legally binding. You have to make that decision based on that. So that's important. Who's making the decisions?
Yeah, those are all great. Those are all great examples, right? So my takeaways, right? Most importantly, understand the debt, what kind of debt it is, and what that means for the property, fixed, variable. Maybe if it's variable, how are they protecting whether interest rates go up again, right? And for how long? Is there a cap? What are they doing? Understanding, you brought up the geography, coastal, non-coastal. I can tell you our portfolio is all in the Midwest, mainly Indiana and Ohio, and our insurance rates are about half to a third of what they are for properties that are down in coastal areas, or especially states like Texas, Georgia, Florida, which have become some of the highest insurance premium states, and so it can be a meaningfully different, right, geography. And then, but I like what you said about just taking the time to really understand the financials and ask questions. And I think what you're really trying to do as an LP is you're trying to challenge their assumptions to understand like what assumptions are you making and how, are those assumptions backed by data? Are they, are they realistic? And because no one can predict the future, but I think the best you can do is at least understand what the assumptions are and where they're coming from. For things like, cap rates and rent growth and some of those things that really move the needle on deals. Because there's several things on a deal, whether it's what cap rate are you going to exit at, right? How much rent growth are you going to see? That small tweaks make drastic changes in how a deal, whether a deal's profitable or not, right? And so really
understand where, it's great you say that because understand where you're in the market cycle. I've seen so many posts lately. We underwrite so conservatively right now, right? We're adding 50 to 100 basis points, which is 0.5 to 1%. So
yeah.
And you know what? Based on the cap rates right now, that probably is, that's probably pretty conservative.
Right.
Well,
because they've already gone up so much.
Right. We literally had 300 to 400 basis, 3-4% rate, cap rate increase in a 2-year period. Well, we were conservative too. We did 100, 150 basis points back then. Well, You know what? We were way off. They went up 2-3 times what those were. So understanding where you are in the cycle.
Yes.
And the uncertainty that is, like insurance has gone down quite a bit recently. Doesn't mean they can't go back up when events happen.
Yep.
But some of the uncertainty around interest rates like that is died down a lot. Insurance has come down some.
Yeah. Started.
These projections around what the market's going to do going forward. Well, look back at what these huge companies projected back in 2024. They're all wrong. 100% of them are wrong. Right. It's not even a question of them being close. So we're all using that data.
Right.
And an investor can use that data. But at the end of the day, it's really risk mitigation and preserving your capital. It's really hard on a true value add deal. We've bought deals that have been 0% occupied, 30, 50% occupied. It's really hard on those type of deals doing that many times to say, well, I feel comfortable, going forward now, comfortable that we can preserve capital. Don't know. Market events are too. COVID hit us when we bought deals. 2 months later, COVID hit. We couldn't renovate any units.
Yeah.
The whole business plan was based on renovating units.
Yeah.
Did we cause COVID? No, we didn't, but we got hit by it. So it's pretty important.
So what, Mark, as we think about it, I don't want to put words in your mouth, but the things I'm starting to hear are, if you're looking at deals going forward, stability, like stabilized occupancy sounds like, something that's important. The ability to have cash flow versus, like you said, having something with like 30% occupancy that you're maybe theoretically could have bigger upside, but it's more difficult to get there. Is it, so stabilized occupancy, fixing debt or having more conservative debt? Are there things that, like, when you look at your box now, that are built in that way?
Yeah, the more unknowns, like you mentioned, you're in the Midwest, right? The Midwest, I could say, it's a boring market. It's boring. Right?
I like it that way.
No, I would agree with you 100%. We've owned there too.
Yeah.
You're not going to have the huge run-ups, generally speaking, like you are in some of these hot markets, but you don't have the huge rundowns either, right?
Right.
So, some places, 5 to 10% dips where a lot of the Midwest in some cases took, versus, the 30 to 50% in the hot markets.
Mm-hmm.
So understanding that what can you control, not control, some things you can't control the market. But like you said, the debt, understanding property taxes, insurance is what it is. But, like some of our areas will get hit a lot harder and things like that. But even when you mentioned about, the stabilized occupancy, well, that's a little bit of a misnomer because, in my opinion, I bought 120 deals and the reality is that a lot of these guys that have sold deals either deliberately or accidentally, are misrepresenting certain things. Some things are easy, right? You go get bank statements. People are like, I'm like, you don't go verify bank statements to see what's revenue. I mean, okay, that's like a number one. But people lie all the time on the rent roll. If you look at it and say, I mean, I've done, again, like 200 PSAs, which are contracts, right? I just know a lot about them, right? But it's like, everyone's like, well, I walk 100% of the units before I buy a property. Yeah, okay, we do too. But fast forward 90 days later, after you're done doing that, and Kent's selling me a deal, and he says, well, hey, we have 10 vacancies, and I'm going to get a rent credit, for each unit's not made ready, things like that. That's part of the contract. We close it and we find another, 12 units that are vacant.
Yeah. Yeah. It's happened to us too.
No, it happens like, so in your contract, you should have, we rewalk. I have the ability to rewalk all units again, whatever, within 72 hours of closing.
Yeah.
Not only that, but if you actually lied to me, whether you lied to me on purpose or not, and now we have a problem with occupancy, we're going to get some sort of credit, either financially, or we're going to back out of the deal completely with no liquidated damages. We're not giving you a penny, Kent. You lied to us. There's so many things in a contract. I mean, I have 2 words in a contract from 2017 that my partner did. I didn't even sign the contract. I was part of the LLC. That cost me personally $371,000.
Wow.
2 words in a contract. And you look at it going, well, that's how you learn a lesson and say, well, that's a pretty tough lesson to learn.
Yeah.
And we've learned a lot of other lessons about, vagueness, if you want to say, in contracts and things like that. So I won't go into a lot of contracts. I could literally talk probably, a few hours to sign contracts, what to do as a buyer or seller. What do you have in there? I've seen contracts for $50 million where I'm like, they're a joke. And people sign them,
Again, Mark, just great advice and thinking about the contracts and the seriousness of contracts. And I love your little tidbit on 2 words in a contract that cost you $300-something thousand because I don't think that people take contracts seriously enough. And like we said, the review on the front end, even though costly, could save you 100 times that, right? On the back end, and just being really careful about what you're signing, I think is well said. And it's a good segue.
Most people will sign it or will read it when there's an issue. That's the first time they read it.
Right.
Yeah.
Right. And that is the wrong way to think about this, and adds a lot of risk into a deal or into your investment. And contracts is a good segue into partnerships, right? So just kind of touch on it briefly, because I think you've got, again, such great experience. What are some partnership mistakes that you see being repeated most often by people, either you've experienced or you see in others?
First, outside of like an agreement, if you want to say, it's like, I trust this person so much. And trust but verify. No, you pretty much verify, then maybe slowly trust. Yeah. It's just reality. People are like, is that kind of cynical? I'm like, no, it's not. Yeah. You need to plan for every single thing to go wrong. Pray that it does, that it doesn't. One of the biggest things, 50-50 partnerships, no tiebreaker. I see that all the time. And then one partner wants to sell, the other partner doesn't. One partner wants to do something, the other partner doesn't. The other thing, not directly tied to partnerships, but somewhat indirectly, is signing as a key principal or guarantor on a loan with other people. And again, term joint several. People may not know what that means, but again, it just means that, each person's individually liable 100%, whether they participated or not in whatever was wrong. And even if something wasn't wrong, lender just wants to sue you. Right? Trigger, a carve out and make it full recourse. A lot of contracts or partnerships, it's really not clear necessarily as far as like who's doing what, who's deciding what, which is kind of bizarre to me. And the big ones really are the biggest one for me is really the decision making process.
The decision rights.
Yeah. And not having, people always think, well, we're 50-50 partners economically, which I get that, right? You can have different decision-making rights from economic versus managerial, things like that. Who is the manager in it? The manager's going to have more responsibility. If you're like, well, I want to be the manager, well, know what you're signing up for. Yeah. You have way more responsibility than just like another, co-GP, for example, on a deal. Those are, there's so many things that can go wrong on a partnership. even simple things, there's a death, right? What do you do? Well, it's not accounted for in there. There's someone gets, divorced. Someone has medical issues. They can't perform. I don't think there's a single partnership, and I've seen hundreds of them, where I would say there are two partners, and actually, you know what? They're equal as far as the amount of hours and work they put in. Every single case, there's always one person that does way more than the other partner. It just happens, right?
Yeah.
And then people, I would say, setting up LLCs together. I wouldn't do that, right? I mean, you have an LLC for your deal, right? And the lender's going to have certain requirements around that. But you and I meet each other. Hey, we hit it off. I really trust Kent, and you trust me, and let's create an LLC together, and we're going to be buddy and all these deals and things like that. I wouldn't even do that, for a long time. Because what you do and what I do is going to impact each other, right?
Yeah.
And there's so many things around, do you even have an LLC that transacts or not? And there's a holding company, and you have bank accounts. What do you do with bank accounts? As far as, it's not directly tied, but it should be tied to the, operating agreement and things like that. Like, hey, you're going to open a bank account. It's going to be 2 signatures. I mean, you probably know, I know many examples where people have stolen money. Not like, hey, we're just used to money. We stole money out of the bank account. And a guy, reached out to me and DM'd me and said that, he got sued because his partner didn't participate, didn't even know what he was doing. They got a default judgment against this guy, for a lot of money. And now he's on the hook for this. So, again, the trust factor is great, but you need to account for everything that's going to happen. And a good attorney will know all these things, because at the end of the day, you want everything in there to, eliminate all the unknowns. I mean, there are things in contracts that are just ambiguous, right?
Right.
Even in other sales contracts and purchase contracts where it's like, whatever is reasonable. Oh, okay. You mean you're going to sue me for a reasonable? Well, I think $100 is reasonable. Oh, you think $100,000 is reasonable? Oh,
right. Who's the judge?
Yeah, industry standard or customary and things like that. It's bizarre to me how these terms are used in contracts, and you don't really, 10 years ago, 11 years ago, I'm like, well, you're reading it, right? Like, okay. Well, you start hitting things, getting your butt kicked. You're like, oh, okay. Yeah. Here's what I need to do differently going forward. So.
Yeah. It's probably, it's only, like you said, people often will read it really for the first time when something goes wrong.
That's right.
And it's all.
I have people tell me, I didn't even know this was in there.
Yeah. Mm-hmm. Yeah. And my experience has always been, because I'm usually a pretty big stickler on contracts, and it's always, people get frustrated at times because we end up negotiating those scenarios that seem like the 0.01%, right, scenario. But it's just because, you want to figure it out now before it becomes an issue. And
no, it's a good point. Figuring it out ahead of time. I would say this is just a small side in a contract. If you and I have a deal, or let's say it's a $10 million deal, and for whatever reason, it's not clear what happens, or there's some sort of issue comes up. I've seen deals pretty much blow up for, a $10,000 dispute. Like before the deal closes, like really, we're going to dispute over a $10,000 thing because of our pride and ego, and you want to win, I want to win. Take the $10,000. I don't give a rip. It's a rounding error.
Right.
So the pride can also come into play in business, for one.
Totally. Yes.
And you're like, that's literally, and I would say, not to belabor it too much, like if you and I have a dispute, you're selling, I'm the buyer, and you have some sort of, I will tell you, hey, here's what I'm looking for. I don't really care how you solve it, Kent. Because you want to be the smart one, looking like you solved it, right? I don't care how you solve it, but here's the concern I have. You come up with something like that. And I've done the reverse, even on things I've done. I've given like, okay, here are 3 different options. I don't care which one they pick. Here are 3 different options. But the whole idea of like, this, I want to win is silly.
Yeah. Yeah.
For small money, right? Big money, I understand.
Yeah. Yeah. Take the ego out of it and be able to just move on, right? Is what you're saying.
And there's no such thing as a standard contract. We've had, contracts where,
Right.
Sellers have signed it and they're like, well, we don't like that. Well, okay. And, transfer tax, for example, in Tennessee, $84,000 of sellers, who's an institution.
Yeah.
Well, brokers calling, yelling at us because, we have that in our contract. You mean the contract that the seller signed?
Right.
The signed contract, but now they're yelling about it?
Yeah.
It's too bad.
Right. Right. You got to understand what you're signing.
Right.
Are there any, because, this is, all these partnerships involve people, right? And so are there any red flags you've identified now as you look at partners that are, have maybe appeared to you as you've gone through all of these experiences?
Yeah, I think your gut, most of us, like I said, have been fooled at some point in time, whether it's hiring somebody, partnering somebody.
Yeah. Your
gut, in some cases, like, not that you thought they were bad, but like, I don't know. But I would say, and I'm not just saying to say it, if you're married and you're a guy and you have your wife, I actually would have your wife talk to the partner, even if they're not part of the business at all.
Yeah.
For whatever reason, they typically have better discernment on personality. I can't tell you how many times
I agree with you.
My wife told me that guy, I'm like, yeah, well, because he is a jerk.
Yeah.
But people do background checks. Again, it's all these. I had a partner that, had every answer you possibly could imagine perfectly nailed down, right? Ended up stealing like $500,000 in deals. And it's like, what is,
yeah.
So it's tricky. I think you're never going to get over that. If somebody wants to do something deceitful, they're going to get away with it. They might get caught, but they're going to get away with it. They're multi-billion-dollar companies that have this happen all the time, right? I think that the legal aspect of it is where, in the document being clear, is where you're going to protect yourself as much. It's really, really hard to really find out, like, hey, this guy actually wasn't everything signed up. In some cases, they're not bad people. We have people that are partners on deals that you can't get a hold of them anymore. They're gone. They're like, I can't deal with this. I'm just, too stressed out. Okay.
Yep.
Yeah.
Well, taking it back to the LP again, thinking about partnership dynamics and understanding that around the sponsors for deals people may be looking to enter into. What are some key questions to ask around the partnership of the sponsor?
Yeah, I would say, have they ever had issues on a property before? And if they're like, yeah, we have, then, what was it? How'd they get around it? Why was it? And maybe how this particular deal is different. If someone said, well, yeah, I had one problem on a deal and the interest rate, floating rate went from 4.5 to 11.5. Okay. But the deal you're going to invest in is going to be fixed long-term debt. Okay. Yeah. I could get over that. Right.
Yeah.
That's a big one, right? Just as far as like what they've done before.
Yeah. What about just particularly around the actual like partners of the sponsors and how they've
how they know each other, how long they've been doing business together.
Yeah. Like anything that you would want to ask now, saying like, for example, your idea of like, well, if they're 50-50 and nobody can make a decision, right? That could be a red flag in there.
I wouldn't even invest in a deal like that.
Yeah. Right. So that'd be something good to ask.
It would be. Yeah. Who's in, and you really want to know from a decision.
Like who's making the decisions,
not
right?
Economic. Cause you don't care economic necessarily.
Yeah.
I hear all the time, like, skin in the game. And I'm not trying to like exaggerate, but when I hear some people starting out, they don't have a lot of money putting in a deal. I get that. And people are like, they have no skin in the game. You mean the 100 deals they looked at and the travel they went to go find a deal, but they have no skin in the game? Just
right. Signing on the loan,
all this other stuff. I'm like, then it's like, oh, you shouldn't have to pay any asset management fees, which, okay, I get, but it's like, okay, when you go in, if your company you work for, your W-2 is having a problem, do you go into work for free?
Right.
That you're going to start doing? Come on, let's be it. But the part decision-making is probably number one. What happens in from a sale perspective, can you be forced to sell? Yes or no, like tag along stuff. like I said, how long they've known each other, how many deals they've done together, what type of deals they've done together. Those are going to be really important. Now, if you're going to partner with somebody and let's just say they're not the decision maker or they're not signing the loan and things like that, I'm not saying it's less of an issue, but it's kind of less of an issue. They have no control to do anything. And they can't go do something to trigger a recourse on a loan or anything like that. So really understanding the person's role. And if they're like, well, hey, I'm the manager, I'm the sole KP guarantor on the loan, nobody else is on it. Okay, then it is less of an issue. Could you have a partner that happens to be a jerk? Well, yeah, you could, but it doesn't mean they can be a jerk to influence the deal of what happens or doesn't happen on the deal. But that's decision making is number one in my mind.
Gotcha. Again, great takeaways. And I mean, with that, Mark, this has just been incredibly valuable. I really appreciate your vulnerability. I really appreciate you opening the curtain. I think so many lessons, for myself, I think for our listeners that we can take away to just, not get caught in some of the same things, or maybe just have a different perspective or ask one more question that helps us make a better decision, So
I think that people listening to this, and I think might be, oh my gosh, I would never invest in multifamily. Why would I? It's like, no, actually, you could and should do it. I was there a year and a half ago. I'm like, I don't think I'm done. I don't want to do anything, right? Yeah. Curl up in a little ball and disappear. And then you're like, no, these are lessons learned. And right now the market's down tremendously, whether it's at the bottom of the market, it's pretty close. And there's less competition out there than ever before. Supply is burning off, all those things. So if you look at the issues that people have had, if they're going to be transparent about it, a lot of people have issues. They just don't want to talk about it. Yeah. What are you doing differently on the deal in the future that mitigates and in some cases eliminates those same issues that happened back in 2022, 2024. And there are a lot of things you can do going forward. You will go slower likely, and you probably make a little less return initially, but in the long run, you're going to be better off.
Absolutely. I think really well said. Market cycle is very important, right? We're in a very different place now than we were in 22, right? And in 23 and as we went up. And so I think that's important. I think also like all of these lessons learned are so valuable on things that you won't repeat, right? And so if you think about investing with people, it's actually good to have people that have these lessons learned and that are hard learned, that won't be repeated. You're a better investor going forward for what you've been through,
100%. And even other things outside of real estate. I help people on other businesses and things like that. Sometimes it's like, what I've learned here, a lot of lessons are applicable across any industry, right? Yeah. So, but like some people might say, hey, you had problems, I never want to invest with you. That's fine, right? That's a decision. Yeah. I can tell you, you better off investing with me right now based on the knowledge I have than you would have been before, because I've learned so many valuable lessons, and and I'm willing to share them.
Absolutely. Yeah. And again, thank you for coming on the show. Thank you for sharing all your experiences. For listeners who want to learn more about you, Mark, and Think Multifamily, how can they reach out to you?
Our website is just thinkmultifamily.com. And if you want to shoot over an email, it's info@thinkmultifamily.com. And, we have a lot of stuff trying to be pushed out around these type of topics because I think it's really invaluable. I really do, for people moving forward. And some people, will hesitate and pause, and that's a good thing. Become educated, pivot. And, I think I'm looking forward to it now for the first time in the last probably 6 months. I'm like, I'm really actually excited again. But before it was pretty rough there for a while. Yeah.
Well, it's excellent to hear that, Mark. And thank you for coming on the show. We'll make sure all that's listed in the show notes. And I hope you have a great rest of the day.
Thanks, Kent. Appreciate you.